I'm Keith McCullough, and welcome to The Outlook. All right, that sounds pretty deep. Well, we'll get deeper as we get into this. What I want to do is spend some time with many of you who are our followers and our subscribers, of course, but again, many more of you who are not. So again, want to get into the depth of the process, the breadth of the process. This cannot be done with one human being. It certainly couldn't be done with one human being without any machines or models. Lots of teamwork here. We have 80 people at the firm and continuing to build out the team. It's been quite a journey. We've seen quite a 15 years here at Hedgeye, and I think this year has to be the most exemplary of risk management. So again, most monkeys can make money in what we would call a quad 1 or quad 2 market. Again, that's when everything go up. Most monkeys die when we get into quad 4, and that's where we are right now. So we'll explain that and how to, again, most importantly, front run the machine, because the machine, i.e. the market, is very good at front running market conditions that become economic conditions and then start to feed on themselves. So again, that's why we use the signaling process to front run the quads, the market signal being a price volume volatility signal, which I'll walk through quickly as well. But again, the signals had it right, the bond markets had it right, the currency markets had it right, and eventually the stock market got it right too. Crypto, of course, collapsed well before that. But we'll get into all that and how the machine reflects on that. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. On slide 4, just to give you an idea on how this game has changed tremendously since I got into this business. And we're only going to focus on theme number 1, by the way. In this slide deck, there are well over 100 slides. But I always come back to this where back in the day, so to speak, when I started as a hedge fund analyst in the year 2000. But back then, global hedge funds assets under management, the blue bars were higher than the gray bars. Now, of course, the gray bars have gone to recent peaks, and then you get your drawdowns. So there's obviously less in the ETFs because the market's gone down, collapsed in a lot of different places. But again, now they've completely eclipsed my former self and my former colleagues and the former way to do this. The former way to do this is Captain Stock Picker, all right? Captain Stock Picker's got the great stock picks, got some pitch decks. We tell each other, everybody's got that whole thing going on, and that's it. Now it's not what you do. So again, you definitely should have some picks, but you have to have a North Star on top of that. So we use a macro process called the quads. I'll get into it momentarily. Again, the quads are the North Star. The signal front runs the star, and then the sectors and the factor exposures and actually the stock and credit picks fall out of that. So we do it, again, differently. We're very proud of that. The way that we've done it has protected people against another stock market, another credit market crash. Again, I guess that's the one thing I can say. Amidst all the mistakes I've ever made, and I've made many more publicly than many of you, I've never missed calling a stock market crash or a quad 4 crash. So again, as we define it, because we, of course, invented the quads, and that's what I have to say about that. Let's just get into that grid in terms of how we show it, and on the quads, next slide, and show people quickly here what we're talking about. Quads 1, 2, 3, and 4. If you go clockwise, you can get to where we want to be. Quad 1 and Quad 2 are the best of times. Quad 2, of course, we're in this quad. I'll show you momentarily for actually right up until this time last year. That's when the NASDAQ peaked, crypto peaked, Bitcoin and the Russell 2000 actually peaked on the same day in November the 8th. Won't that be a wonderful anniversary today while everybody chases the latest narrative. But from here, we went to Quad 3 stagflation, and now we're going over here to Quad 4. Okay, so if you go to slide 20, guys, we can show you, again, just the history of it all. And again, all this is showing you is the rates of change of both real growth and inflation. When they're both slowing at the same time, which they clearly are now, you get Quad 4. Okay, so these are the next 3 quarters. Okay, we're currently in just finished reporting Q3, but the next 3 quarters we have Quad 4. The most recent quarter was Quad 4, and prior to that it was 2 Quad 3s. So what you have, Quad 3 being stagflation. So stagflation, going back to the grid, is when you have inflation accelerating, again, year over year, and growth is slowing on a real basis. So that's what happened. Market didn't like that, started to collapse. The Fed had to raise rates to fight the inflation, et cetera, et cetera. Now we're in the main line of the slowdown, where inflation has clearly peaked at 9.1 or 9.2%, all the way down to 8.2, but it's going to go lower than that, not fast enough for people. I'll show you again how our nowcasts look. And you get just into the mainline slowdown. When you go quad 4, quad 4, quad 4, quad 4, you might say that's bad, and I'll say yes, it's very bad. When is the last time we had 4 straight quad 4s? Coming out of the 1999-2000 growth bubble. I've said this many times, I'll say it again. This is the mother of all bubbles. Far bigger than that bubble. I mean, crypto alone, the components of that and the fraud embedded therein, we're seeing a lot of pin action on that today. Is it Sam Bankman-Fried doing a great job? But again, there are a lot of things that have happened so far. But what is happening today in crypto is not emblematic of a bottom. All right, it's emblematic of a bubble, the mother of all bubbles coming undone. So if anything, like today or whatever day that they're rallying on whatever, it doesn't matter. The cycle matters, of course. But again, looking backwards, you can see that the best of times, again, when we had 4 straight quad 2s in the U.S. in this period, that was the best of times. I mean, that's when you could buy a company that will eventually be bankrupt and stock would triple twice. That was fun. We were long back then too. It's okay. We go both ways and we like it. So again, that's an important thing. Let's go back to the signal that front runs the quad. So go to slide 9. Just for those of you that are not properly aware of how we talk, I made all of this up on my own. So again, trades, trends, and tails within the lens of front running our grids or the quad. This is where we're at. So again, currently we're bearish on all 3 durations. That's called a bearish formation. Trades are 3 weeks or less, trends are 3 months or more, tails are 3 years or less. No, we're not using simple moving monkeys. That doesn't work. Okay, so again, I use a 3-factor model at the bare minimum, which is a price, volume, volatility model. And it's how all those things relate to each other. Okay? So again, it's the vol of vol, or the volatility of volatility, that determines the future state of whatever asset class. If the vol of vol is breaking out, volatility is breaking out, and volume's going up at the same time. So let's say we got the price going down, we have the volume going up, and we have, let's say, the VIX going up in the case of the S&P, that's very bad. That is not a good cocktail on the 3-factor model, and that will give birth to something that goes up, like this, like the bull market did, all the way up until January the 3rd, and then it starts to break down through trade, then it breaks trend, and then it crashes and collapses, and that line shouldn't be green, and I'm not trying to mess with you. Yeah, you can do that. You can notice that I'm seeing a crash and I use green. All right, we got to move on here. All right, so again, trades, trends, and tails. So if something goes bullish from a trade perspective, typically in a bear market, it happens a lot. In fact, some of the biggest trades there ever will be are in bear markets, because the catalyst for a bear market bounce is what? The election? No. The catalyst for a bear market bounce is that the market went down. Okay? And the big catalyst for a big bear market bounce is that the market went down a lot. And that's happened. All right? So we've had crypto at one point was down 72%, 73%, NASDAQ down 36, 35, 36%, S&P down 25%. Then you get a bounce, and then they come back with their new narrative. We do not do narratives. We do numbers. Numbers are better than narratives. Might create a song. If I don't, somebody copy it. Call it your own. It happens to me all the time. Let's go to slide 13. So the rates of change, ROC, write that down if you're new to this. It's not about the levels of things, evaluations of things, the narratives of things. It is about the rates of change of things. So if only you did this, so again, this went straight up, okay? So this is the peak growth rate that you never say never, but it's certainly the fastest growth rate year over year in the history of the U.S. post-World War II, all right? So that growth rate slowed here, and then it reaccelerated in the 4th quarter last year. So that was the peak. You had an acceleration. The rate of change of growth and of an inflation, quad 2, was accelerated. Then it was like, oh, shit. The peak was in. Oh, but it's still good. Everyone's in good shape. Everything, the consumer's in great shape. No, the consumer's in post-peak shape, which is 100% of the time when you feel your best is after the peak. Huh? So in rate of change terms, that's when things started to shake and break. Oh, they're not going to the moon again. Then they cut that growth rate in half again. And here, by the time we get to the bottom of quad 4, we have the growth rate going from plus 12.5 to negative something. That's called a recession. And I don't particularly care who agrees or disagrees with it, because I'm just going to execute on it. All right? Let's go back to a slide that we skipped that I didn't want to skip, and I didn't mean to skip, but on slide 5, back to the process. Let's bring it back. So if you could, you would. If you could pick the top of the sine curve and the bottom of the sine curve, you wouldn't have to pick bottoms. It's a stinky business. What you would do is you would just take those numbers and you'd say, okay, 12.5, remember that 12.5 I showed you? That's the top of the cycle, and for now, minus 0.2 is the bottom. So everything along the lines in between here is called the cycle, in as much as on the way up it was a cycle. So again, that's why I say tops and bottoms are processes, not points. It's also why, I've already mentioned it, just to review, I don't use these things that you see on whatever, Rear Vision, CNBC, Bloomberg. They even have the political side to it. I mean, left-leaning, Bankman run, Friedman, whatever it is. It's about how it feels or the valuation, and I have a theory about it. And this time is always different. Remember Rug Paul calling for Ethereum to the moon? That's bad. That's bad. I mean, why wouldn't you just start with like reality? Math, that works. Rate of change, ROC style. The rate of change will set you free. The history of things. Cycles have a rhythm and rhyme. They're never the same, but they certainly repeat in terms of the sine curve. And then you have behavioral overlays, which gives you a lot of, I would say, information in a shorter term duration in terms of positioning. So don't tell me everyone's bearish. Show me that everybody's now scared to be position bearish. Guys, if you show today's implied vol data, for example, I'm not going to spend a lot of time on this because this is not a teach-in on our entire process, but just to show you today, after the latest 3-day bear market bounce, you have implied volatility discounts that have developed on the order of 19 to 20% for the S&P 500. All right, so that number today, where are we today? That's S&P right here. This right here let's use red because this is a negative point I'm trying to make if you can't see that. Minus 19 right there. Wow, that's not like before when people back here a month ago were buying puts. So again, implied vol premium means that people are buying puts. I'm just giving you a shortcut here. Implied vol discounts mean that people are reticent. They're scared. The bottom's in. Election's my latest narrative. Whatever it is. By the way, our narrative on the election isn't a narrative. If and when the Republicans win the House, that's just going to confirm the real pivot that we've had, which is the election means a hawkish Fed. He is a Republican, don't forget, and he is hawkish, fighting inflation. That's what's winning at the polls. And you're also going to get less cowbell. You're going to get a lot less free money. Okay, so this election, if it plays out the way that the market's been discounting for quite some time, rates up, stocks down, is just going to start to repeat itself. Okay? So we don't need to do a whole series on who thinks what from here to Cincinnati, Ohio. Okay? Let's go to back to slide, let's do slide 14. So on slide 14, and again, we update this for our subscribers every single day because this data updates every day. I'll show you that in a minute. Every single day we get new data. I'm not looking for a narrative, I'm looking for the next number, okay? So in terms of how Wall Street reports GDP numbers, you're gonna go from up 35 to minus 2 to 2 back to back. That's gonna be the first half of next year. If you're looking for a spot where the recession is fully priced in, and I mean fully with the profit recession, because when GDP goes negative, companies that are tied to GDP go negative. If you can't cut your costs because labor won't go down and inflation won't go down as fast as your revenues are, you get a faster profit recession. So while higher interest rates and inflation, all calls that we made, again, are now appropriately priced into the market, there is absolutely no pricing in of a full-blown profit recession on the order of, from cycle peak profits, could easily drop 30 to 45%. Now, in theme number 2, I break that down. That's called the profit recession. I'm not going to do that today. We're still focused on theme number 1, which is a global quad 4 recession. So again, slide 15, and we're just looking at the U.S. nowcasts. We have a nowcast for every one of the countries that we follow, which is 50 different countries. I'll go back to the top 20 in the G20 momentarily. But again, here you are, no matter where you go. Inflation, and by the way, we went long, dong, silver of things like silver back here when people didn't want to be long of the asset class that is commodities or the investment theme that is inflation. Literally right here, right here. Call some friends, call some foes. Right to there. That's a pretty good run. 1, 2, 3, 4, 5, 6, 7, wait on it, Mucker can count, 8, 9 quarters of being long inflation. 9 quarters in a row of being on this side of the grid. Stars, stickers maybe. That's quad, this is quad 2, and this is quad 3, right? Now, as this goes this way, and it just barely started to, and it's going to start to a little faster, but not fast enough for bulls that need inflation to go down quickly. So you have somebody who's never traded a market in their life, like Scott Wapner. Where do I buy stocks? It's always the question. Mine is, where do you sell them, Scott? Love you. So this ain't coming down anytime soon, but it is coming down in rate of change terms. And it's not coming down fast enough relative to your revenues. So that's the whole point. So you substitute GDP in our 4 quadrants. If you were to separate, just substitute, I should say, separate your mind from GDP versus inflation and go revenues against cash flows if a company has it. What you've noted is that companies that don't have it are getting eviscerated daily. What we're really talking about is going to one of this side, which is quad 4, and eventually when we're coming out of it, we'll go to quad 1. All right, so quad 1. That'll be the bull market call of Hedgeye. We've made it many times. We started making one. I made it in April of 2009, for example. I made it in the 4th quarter of 2016, for example, coming out of the low of the cycle of 2016. There's plenty of opportunity here. Q2 of 2022, or Q2 of 2020, all the way to 2022 on inflation. So again, don't tell me about people being one way with a milkshake. There are 4 quads, and only one of them I'm long the dollar in, and that's quad 4. The other 3, underweight dollars, long other things. That's why this is a process. People pay for a process that's repeatable. If they're paying for a narrative or they're paying for talking points, they probably don't know what they're doing, or they're going to learn that the hard way. That's why we're critical of the other things, because they don't work unless you're selling a subscription to that, right? So again, don't sell me a story or sell me a book or a narrative. Show me the numbers. All right? So we take this, superimpose this, go to slide 16. So our model has 30 unique features. They're all weighted appropriately for the impact on GDP, for example, in this model. And if you go to September, right here, this is what September was. And I'll give you a hint what it was. The color red is bad. The color green is good. Now, if you go back to the best of times, back in 2021, you had these kinds of lights go up on the Christmas tree. If you don't celebrate Christmas and any other holiday, fine. And then in November, it reaccelerated here too. So these are real tough comps. So by the time I fill in the page for the subscribers, and instead of this and this, it says October and November, which we update our clients and subscribers on every day as we get new data points. So you got 30 data points per month, 90 per quarter. 90 times when people say, where could you be wrong? Where could the bottom be in? I need a bottom. I don't need a bottom. I need another data point. I need a market signal, price volume volatility, and another data point. And then I do it again, and again, and again. Until I see green lights. There are no green lights. These are red lights. So again, that's the process. It's not that complicated in terms of articulating it. It is very difficult to build it. It's very difficult to execute on it. If you build it and understand it, it's still hard to execute on because you have these 2 things called your ears, and in between those 2 ears is your main problem. That's why you rely on a lot of these talking points and noise and moving monkeys, and I go, da-da-da-da-da-da. Doesn't matter. Doesn't matter. The stillness, as Ryan Holiday would say, is the key. All right? It's all about the signal and the next data point. Okay? So back on slide 20, when we say global quad 4, global quad 4, imagine I had an accent. I would sound like I should win a Nobel laureate. But I'm just mucker. I'm just a grinder. So what I mean by that is that instead of the whole bloody world being in quad 1 or 2, so the mean and the mode of the top 20 countries, you can see that, right? You can see the 2s, 2, on and off. And then most recently, the world went into global stagflation. That means that their inflation is still going up year over year. And then it goes to the next 2 quarters where the whole bloody world's in quad 4. Oh, shit. That sucks. But I need a... What are you saying? What are you talking about? What are we talking about here? What is the catalyst for this to stop? Some super-duper valuation? No. It's time and space. Time and space. And at some point, when we get closer, and again, I'm not saying that this last quad 4 in the USA has to be the end. Wouldn't that suck if the next one's a 4 again? Could happen. There's still a chance. The market will at some point start to discount 1 to 3 months maybe. Sometimes it's 1 to 3 days. Again, I don't know. I do not have the arrogance that many do with their 50-day moving monkeys. I think that's quite arrogant to claim that you can read a chart with a back test. We back tested the 50 and the 200-day moving monkey. They don't work. If they worked, I'd use them. Yeah, they actually do work. They work as contrarian signals. So again, when you broke out above the 50-day in August on the S&P 500, oh, what a great call. How about early October? Oh, jeez, didn't work again. Oh, let's keep talking about the charts. Keep getting mad at Mucker because he makes fun of our charts. I don't do that because it doesn't work. I do my signal and I do the quads. It's not being critical of you. It's challenging you. It's giving you an opportunity. That's why we're doing this for free. I'm really quite upset about how many people lost a lot of their retirement this year. It's terrible. What Rug Paul and these people at Rear Vision did with just trying to get people to click, trying to get the people to believe. They got paid, but there's a suicide hotline there. People have lost a tremendous amount, and it'll take them a long, long time to come back. Hedgeye Nation doesn't have to worry and cry and whine about that or worry about my delivery, about what's wrong with what had people positioned that way. Okay? So again, what we're trying to do is preserve and protect your capital. We're trying to help coach you through it. Good coaches are hard to find. I'm certainly not the greatest, but I'm getting better than bad at coaching. And if you have the ability to be coached, you're going to lose a lot of baggage. Now, a lot of people in Hedgeye Nation will say this. They'll say, you know what, Keith, thank you. And I've had father, daughter come up to me, and we're going to be in Dallas tomorrow night at the Hedgeye Live. It was amazing, humbling, suffice to say. You've changed our lives. I haven't. My team has, and you have. If you had the ability to get rid of your baggage, it's a very common thing for somebody to say, I had to unlearn a lot of bullshit, right? If your process starts with politics, I really do pray for you. That's a terrible thing. This is not a political process. This is a data-driven process, rule-based process, okay? Slide 23, just so you know what the globe looks like. I'm not just going to call it 20 countries. That would be ridiculous. Again, this includes all of emerging markets. And the summary, again, is worse here. Because, again, most of these emerging markets with a strong dollar get a crashing currency. And then we have 3 quad 4s after 2 quad 3s. So it's a terrible thing. We're actually long Turkey right now. Why? Well, Turkey's got a 1 at least. And the signal says buy Turkey. It's overbought today, so don't run out there. I'm not trying to give you a pick. Right? This isn't about giving you picks. CNBC spends their whole day trying to get you to believe that it's all about some stupid stock pick. If you are stupid enough to believe that, you deserve to lose money. What you need to do is figure out where the cycle is. Because it's not about talking points, it's not about narratives. Again, it's about the cycle, stupid. You get that right, get the quads right, which the signals will front run those things. You'll get many more things right, including your stock picks. Only certain kinds of stock picks work in certain environments. All right, so with that, we have theme number 1. I think it's on slide 26, guys. Yeah, is that it? Yeah. So when we're carpet bombing your inbox with these, I think we're pretty clear. Some of you got this for free. I think were we clear? Are we clear? Are we the only firm that was bullish all the way up until the end of last year, went bearish, and on every bear market bounce reiterates bearish? I think so. In fact, I know so. At least of the firms that have the humility to get up every morning, do the job, be transparent and accountable about every single move and not get shaken out. That's important, right? That shows that we have experience, we have a depth in terms of the team. So again, if I'm wavering on something that my teammates can keep me in check with the data, it's a real important thing to have. All right, jump ahead to the cartoon. Let's just jump into this slide deck. We're 25 minutes in. We'll see how much more gas I have in the tank here, but you're gonna see that I have different ways of saying the exact same thing. So let's do global quad 4 recession with a cartoon. Thank you to Bob Rich. For those of you that have signed up, we have many people that have signed up for our cartoon. He is the world's best. I just think he just shows it a lot more simply than I can. Next slide. All right, we're gonna go a little faster here, guys. Gotta get the technology going here a little faster. All right, so we like to start with some jokes. That, of course, is what Janet Yellen said in September. Since then, on slide 29, you can see the global synth-a-thon is accelerating. When you see stuff like this, oh, it's only the highest number ever. It's only the worst trade balance since ever. Global bond yields and the biggest decline ever, forever and ever. You know, ever's a long time. But you're in a real hurry to call the bottom, all you people out there that didn't call the top. We didn't call it top, we called it topping process. All the while, we have the Fed, slide 30, proud sponsor of the, what the fuck formation. I think it's okay to say that, right, in real life? You think that had any impact? Do you think that has any lasting impact? You wonder why so many people are quite literally begging for a pivot. Begging and pleading for the thing that created the mother of all bubbles, which was what? Easy money. Easy money. Now your mortgage, so again, if you're using that chart, the 30-year mortgage rate, first of all, it's never gone up to this level, never mind at this pace. You think that that's going to, so let's just say that the Fed stopped raising rates tomorrow, but they kept them there. Do you automatically, as a gainfully employed, hopefully a U.S. citizen who has a mortgage, get your interest rate goes back to a 4% mortgage rate? No. People are missing this point entirely. There has been demand destruction. There will continue to be demand destruction, and there will be a lot less to go around as people have to pay those types of rates at the household level on the mortgage. So that's obviously, there it is. The Fed goes from we call them from vol warden to vol catalyst. Vol warden being at every other time that the U.S. economy would turn negative, the Fed would turn tail dovish, including obviously Bernanke at every turn, Yellen at every turn, Greenspan before all that. And even Powell, he did in Q4 of 2018. He was lying on the floor, remember that, in the fetal position on the linoleum floor, just curled up. Man, I'm a rookie on the job. Tightened into that quad 4 slowdown. I shouldn't have done that. I just got a call from Carlisle. That ended. But again, just sink past your nose for a second here. What if we're undergoing a political shift, a regime shift, where you have a party that's going to roll tonight? I'm not a Republican. Get over yourself. I'm not a Democrat either. You kidding me? I'm Canadian. Right? They lean left. I don't. I'm just right here, right in the middle of the screen. Right? So again, just think about it. What if it's 1980? In fact, let's jump ahead. Let's get all creative on people here. Let's go to slide 48. What if it's 1980 and you do have Paul Volcker and you have a Republican House coming into the mix, and potentially, like 2 years from now, let's say 2 years from now, the dollar, the move you've seen in this first part of the move, is what we see here. Wow! Get out your charts! Right? Remember this? Who remembers 1980, the 1981 recession? Was that the end of it? Like, do we have to hide the rest of what happened there just for the sake of an argument? Pretend it didn't happen? It happened. See that? It's color me green. Ooh, look at this. Charting system, mucker. Charted. We're going right to where they were in the last recession, by the way, and the dollar had stayed strong for a while and wreaked havoc. It didn't just go up here, take a cup of coffee, ask everybody how to get paid again, and go back and partner with FTX and Lunacoin on your Lunatat. No. If this is indeed a political shift, where you have a party that says no more free money, cost of capital is going to be higher, no more fraud across all of crypto that was legally, as my friend Jim Chanos calls it, legal fraud. No, actually, we're going to have a different setup. You guys, anybody remember what happened? So in 1981, we had a big recession. Here, we've not allowed the country to have a big recession. Maybe we're about to. Right? Powell didn't sound like he was moving off that on Wednesday, did he? Nope. Now, what if this just continues and continues and continues? I have had every month for almost 11 months, people send me charts. Dollars top, dollars, like we're going to get another one today. Let's break it down. Who are these people and where do they come from? Do their charts only go back to like here? Like they don't know the rest of economic history, cyclical history, the history of recessions? You notice how the dollar gets very strong during a recession? That's because people, why? You need to know why? You need to get a white paper? These slides are on white papers. It's because people go to cash. People lose their job. All right? So No green lights there. Now, here's a bit of a doom loop for some of you if you want to get into this on slide 37. So this is a problem, okay, because this is a problem versus the prior regime of easy money. Okay, so our currency, your problem. Call this the US dollar doom loop redo. Maybe I could be like Rubini and fly around in a helicopter and scare the shit out of you, huh? This is just what's happening, okay? I'm not a scary looking guy to most. So we have a stylized US dollar doom loop. The dollar goes up so we're in quad 4, economy's slowing, okay? Let's properly doom this up. Quad 4, growth slump. Fed tightens, that's a policy divergence. We got rates up, dollar up. Oh, shite. Then the dollar, we get that exported deflation. Foreign currencies go down in a ball of flames like the Argentine peso. Pick one. Pick 6, all over the place. Global central banks are forced to tighten in the slowdown. 83% of central banks currently are tightening into a slowdown. I'll come back to that. Tightening into quad 4 globally. It's never happened before. What could possibly go wrong? Could we please have another talking point today that doesn't get deep into the weeds on these quads? And then it exacerbates further slowdown. So that's it. That's what we've been going through this year. We've been going through, again, sometimes quickly, sometimes slowly. That's the way risk works. Slowly, then all at once. And at the point that this thing is far gone, which I'd argue we're well past that point, you can't take it back. All right? So you can't take that back. We also show this back on slide 32 in terms of what we call, or Christian Drake does, nonlinear propagation. Now, I would love, can you imagine if like Fast Monkey started with, Melissa would say, hey, can we start with some nonlinear propagation? Can we just go through this? Absolutely not. You would never want to cite the only firm that's nailed this top to bottom right. Why would we do that? We hate on them. They disprove us. I love it. Slide 32, you want the back test on that quad 4 point that I made? There it is. Only quad where the dollar goes up. So easy a mucker could do it. Quad 4, that's back tested. That's the expected value against the quads. Again, back to that grid, the GIP quadrant. And that's kind of one major point that we keep making here. So if you're sitting there staring at dollars today and you've missed the entire move, stop getting scared and just buy the damn thing, buy the damn dip. Add to the dollar core position. It's been our number one core long since the beginning of the year. And yes, I would buy more. What a tip. We're not here for tips. We're here to help you execute on the process, right? Slide 34. Now, the problem with the dollar is, of course, that the world is just locked and loaded in debt in dollars. So this on the left side shows you total U.S. debt, domestic non-financial sector, in billions, which means that says 68 trillion. And then on the total foreign denominated dollar debt side, it's obviously in the trillions as well. So what could possibly go wrong as this doom loop continues? Well, what happens is that you get a global liquidity squeeze. Obviously, this is in motion on slide 35. So this is showing you on the left side, the Dixie, the dollar index in rate of change terms, doing, oh, look at that. Oh, damn it, you didn't do that, did you? Telecom Tom saying it's 1982. I love you. That was the dumbest call I've seen all year. All right, he said it's 1982. Tom, you just want to like skip the 1980-81 part, dude? Only you. I love you. All right, now, let's do this. So, you guys having a little fun in there now? Yeah, we're good. See this? The same point on that slide 48 is the same thing that happens in here. That's the rate of change rips. Because we got this guy Volcker, this time we got this guy Powell. And the 2-year yield, remember 2008? We're using a different period. Well, back then they were like, Bernanke, please, stop it. And he did. This one's going up, and he's like, nope. That's the doom loop. You get rates up, dollar up. You can see it. You notice I'm making you read less. I want you to read more books, actually, and less bullshit. Spend less time on zeroedge.bomb, all that stuff. God forbid you're part of Inverse Kramer Club reading that stuff. Can you imagine the amount of brain cells and life and precious cycle lifetime people have wasted this year? Wow! Then you got all the other players. It's a global currency war, as my friend Jim Rickards wrote a great book. You can't out-hawk the Fed here. So you think we have problems? You think I have problems? I got a lot of problems. We all do. We're all human. Slide 36. I mean, the British have really big problems. So you can't out-hawk them. Today they just showed the highest food inflation number ever. Ever's a long time. Weakest since ever, British pound. Chinese yuan, those Chinese guys are just having some kind of a heart attack. And he's getting rid of anybody that disagrees with him. So that's right there. You got the euro, which is an experiment gone bad. And obviously the yen's at a 25-year low. So again, that feeds, back to slide 37, the doom loop. And again, back on slide 38, in deep quad 4, it's all one big US dollar correlation. So you can see that today. So instead of whining and complaining and just being generally unaware, Eric, can you find today's inverse correlations versus the US dollar? Are they green or are they red? Inverse, hint, that would be red. So why would you buy gold or silver today when the dollar is down, when they have like a 0.77 on gold on the immediate term? Now the trending 90-day plus, remember that's 3 months or more. That's about as obvious gets. And we do have some subscribers who've told us, look, I'm colorblind. Can you just tell me the number? I'm like, yeah, well, the number is 0.8, 0.9, negative, okay? So that's what's feeding the beast on this big correlation trade, okay? And then you got the chop, and I like this one. This is good. This is the average one-day change falling up or down days. Because, of course, we're coming out of a bubble, so everyone wants it to be all or none. So you get these 2 to 3 day moves one way, and then you go 2 to 3 days the other way, and you chop people up. That's very typical of a playground that I like to play in. The playgrounds that I grew up in Thunder Bay, Ontario, they were not like no-risk playgrounds. I went to like 5 high schools. You know, where my kids are growing up here is a little different. But in the real world, there's a lot of risk, especially if you run your mouth, you blow up people's money, you lie to them, you cheat, or you steal. So this playground is called the chop. So in the chop, simple bucket of volatility. The VIX is between 20 and 29. What happens is that everything's back and forth with a downward slope. Gotta call the bottom, and then all of a sudden you get your face ripped off again. Remember, actually today, on this day, I walked through it on the macro show, a lot of back and fill here. If you want this to be easy, find somebody else, right? And every day, God willing, 2 feet on the floor, 2 hands on the keyboard, full team behind me, with me, all locking arms. Red Rover, we call the old wall over. Okay? Not an easy job, especially if you don't know how to trade and you don't know how to fade. So in the fade, that's where the chop's great, the fade move. So again, 5'9", chubby Irish guy, I need to fade it off the backboard, I can't dunk. So I fade. So chop means that on market up days towards the top end of the range, you sell aggressively. And then on market rallies, like we just, or at the low end of the range after market rallies rather, you cover some. So it was actually on Thursday. It seems like a career ago for many of you. It isn't. It's actually just part of the game. Thursday, I sent out a sell dollars, US dollar signal. You can look at that in real-time alerts. It's all time-stamped, every mistake fully loaded since 2008. That one wasn't a mistake. But you covered all my shorts pretty much, went long some names. Now we do the opposite. Get a 3-day rally, dollars approaching low end of the range. That's how you do it. That's the chop. All right, now if the VIX gets out of the chop bucket into what we call this is a public, actually we call it the fuck bucket. Okay, so that's when the VIX is greater than 29. Okay, so we'll call that, man, come on. It's just going to make a great point. VIX greater than 29 equals F for bulls. You don't want that to happen, okay? So that's just something to think about tactically as you continue to think. And how about financial conditions? Just bringing this back. Like some of the things about the cycle you can't bring back. Inventories are at the highest levels ever versus sales. What could possibly go wrong? This is the Goldman Financials Conditions Index. I got no problem using some Goldman data. I don't use their process because they don't have one. The sell side of Goldman, they're trying to get you to actually execute. Open an account, make some trades, and hopefully they have a basket for you. Now, think about this. When things go squirrel, here's the recession that I was on the right side of, was on the recession of this one, started Hedgeye in 08 with a market crash call. We're on the right side again, all the way out here in time. That's the thing about cycles. You got to be crusty old guy like me now, 47. God willing, I'll see another cycle, but this is just a cycle. When financial conditions go like this, you notice how there's a time and space to that? Yeah, You remember? And that's with Greenspan going dovish. Cycles trump central bankers. Then you have this one where you have both the Treasury, Goldman guy, Hank the Tank Market Paulson, Red Rover it with Bernanke. As dovish as seen. Didn't matter. That lasted. Oh, but this one, it's just going to go up here. Everyone's going to get long. Oh. You see? Just doesn't work that way. There's a very high chance that this goes higher and that it stays higher. Because what is that most linked to? The rates of change of what? Corporate profits going negative and down? Yep. Nailed it. You're getting good. Demand destruction accelerating. Look at those inventories. Now, we haven't even gone through these retailers. At least Amazon was being honest about it, firing people and telling you that they're not going to prepare for anything other than something that's heading towards a consumer recession. You have the highest inventory, this is the most inventories in American history. I mean, you're not even close to anywhere top on that chart. All right? Unfilled orders collapsing. Like, do you really need, like when I talk about, back on that slide 16, show it quickly. When I talk about being data dependent and taking in the data that comes in every day, that includes orders, that includes inventories, that includes demand, that includes mortgage rates, that includes at the top line of that, which is real personal consumption growth. You see how that's still just inside of 2%? Well, what we're saying is that that's going to go towards zero on a real basis. Okay, zero's not good. And the other side that's really started to get worse here, back to slide 42, is rate-sensitive consumption. So again, if you're a consumer and you are sensitive to what I said, which is a 7+% 30-year mortgage, well, look at what's already happening to the luxury home sales market. And that's the rich people. Shit. We can't just like let the poor people eat it this time like we have every other time politically. Well, I wonder why the Republicans are going to win some points. Brian Deese and that. The head of the economic whatever establishment committee for the Biden. And there's no inflation, it's transitory. Now there's no recession. Believe the same guy. That's the definition of insanity. Doing the same thing over and over again. People with money are selling big time. Selling soccer teams, houses, boats. I'll buy some of those things. I don't want to buy a soccer team. I think they call it a football team. Now, here's that chart on pivot. Now, what kind of a pivot was that? Slide 44. And I'm going to wrap up here in a second. But again, in every other cycle of the modern era, the Fed has pivoted and gone turntail dovish because that's what Republicans and Democrats did. There was a bipartisan support to turntail. Not this time, baby. No bueno. That's what that chart says. Now, at one point in the year, rate hike expectations actually went away. You're predicting, and I want to end on this. The market was predicting the end of rate hikes and the beginning of rate cuts. Now the difference is there's been a pivot up, as the chart just shows you. There is going to be an end of the hike, but what if there is no cut? That's it. That's what I have to say about that. You're grown men and grown women. We do have some children watching. Thank you for joining. Teach your parents a better way. But again, if and when we get to that moment, and again, to review, on slide 15, at that point in cycle time, when the Fed is done with their last hike in February, you're still going to have inflation. Look at it. I mean, you're still going to have inflation at a level that is unacceptable politically. Right? Now, you can tell me, well, I looked this and that up and yada, da, da, da. And it's fine. Fine, I got it. But at that point, inflation is going to be still between 6 and 7%, which is a three-bagger at a minimum, the target rate. So we'll see. We'll see. I have to thank, and I will, because I have no problem collaborating with people that have edge, that have expertise, that have process. Daniel DiMartino Booth was the first person to say, Jay is much more hawkish than people think. He's more pissed off than people think. Don't forget that Janet Yellen tried to get him tossed, threw him under the bus. Think Jay liked that? Yeah. The dude's worth like over $100 million. Why would you stay? Why? it makes me cringe to think, like, unless you had a political point that you wanted to achieve. In this case, he says it all the time. People don't want to listen. Wall Street wants to hear a pivot, dovish, and Main Street wants to see the inflation go down. And you have, for the first time since Paul Volcker, a guy that's actually doing what he said he's going to do. So you got a pissed off Republican who's now got a lot of power. He's got, the only thing better than that is people yelling at him from the other side, telling him to stop it. He's like, no, I'm not going to stop it. So think it through. Next time you have FOMO or whatever you have, there are a lot of emotions people have, just please try to check them at the door. If you have time, the hardest thing to do is take the time to understand, have a process, have one that objectively turns when things are actually turning, not when people need them to turn, and say, okay, deep breaths, another bear market bounce. We're actually going now into a global quad 4 recession, which is far worse than just the US being in quad 4. And that's going to play out however it plays out. Thanks for joining us.